Ever scrolled through TikTok or YouTube and seen people bragging, I bought the dip in Apple, or I just made bank on Tesla stock? And you're sitting there like, wait, what are they actually buying? Well, today we're diving into the world of stocks, what they are, how they work, and why people get so hyped about them. Stick around, because by the end, you'll understand stocks better than most people who only talk about going to the moon. So first, what even is a stock? A stock is just ownership in a company. When you buy one, you literally own a small piece of that business. Here's a better way to picture it. Imagine Netflix as a giant pizza. The company cuts it into millions of slices. Each slice is called a share. Buy one slice? Congrats, you're officially a co-owner of Netflix. You might not get to decide which show gets renewed, but you do get a real stake in the company. So yes, when people say they own Google stock, they actually own a tiny piece of Google. Now you might wonder, why would a billion-dollar company give away slices of itself? The answer is simple: to raise money. Running a company is expensive. Factories, new products, employees, expansion. Instead of taking a massive loan from a bank, which comes with interest, companies sell shares to the public. Investors fund their growth, and in return, those investors become part owners. Let me explain with a fun example. Meet Zara. She's building a video game studio called Pixel Quest. Her dream game requires $200,000 to launch, but she only has $80,000. So she splits her company into 20 equal shares, each worth $10,000. Zara keeps 8 shares for herself and sells the other 12 to investors who believe in her. One investor, Ryan, a gamer who loves indie titles, buys 2 shares, meaning he owns 10% of Pixel Quest. Fast forward a few years, Zara's game becomes a massive hit on Steam. The studio's value jumps from $200,000 to $1 million. Ryan's $20,000 investment is now worth $100,000. That's a huge win. But if the game flopped and the studio's value dropped to $100,000, his 2 shares would only be worth $10,000. That's the risk. So how do people make money from stocks? There are 2 main ways. First, capital gains. The stock price goes up, you sell, and you profit, just like Ryan did. Second, dividends. Some companies, like Coca-Cola, share profits with their investors every few months. It's basically a reward for being a part owner. That's why people love dividend stocks. Imagine getting paid just for holding on to something you already own. All right, so where do you actually buy these company slices? Through a stock exchange. Think of it like eBay, but instead of sneakers, people are buying and selling businesses. The biggest ones are the New York Stock Exchange and NASDAQ. And here's the cool part. You don't need to wear a suit or shout on a trading floor like in the movies. These days, you can buy stocks right from your phone with apps like Robinhood or Webull. When a company grows big enough, like when Spotify went public, they list on an exchange so anyone can buy in. Here's something most beginners miss. Not all stocks are the same. There are 2 main types. First, common stock. This is what most people buy. You get voting rights and maybe dividends. It's higher risk, but higher reward. Second, preferred stock. No voting power, but you get guaranteed dividends and better protection if the company crashes. Think of it like airline tickets. Common stock is economy class. More crowded, but if the flight goes well, you might reach new destinations. Preferred stock is business class. More stable, guaranteed perks, but less exciting upside. So why bother investing in stocks at all? Why not just keep money in a savings account? Because banks pay 1 to 2% interest, while stocks have historically returned 7 to 10% per year long term. Here's a quick reality check. If you saved $100 every month for 30 years in a bank at 2% interest, you'd end up with about $49,000. But if you invested that same $100 into the stock market at 8% returns, you'd end up with around $150,000. That's the power of compounding. Your money literally grows while you sleep. So there you have it. Stocks in simple terms. Their ownership in real businesses. Companies sell shares to raise money. Investors profit through rising prices or dividends. And over the long run, stocks can grow wealth way faster than savings. If you're new, start with companies you actually understand. Maybe the brands you use daily like Apple, Nike, or Netflix. And remember, don't put all your money in one stock. Diversify. Spread it out. If this video made stocks feel less confusing, smash that like button, subscribe, and comment below which financial topic you want me to break down next. See you in the next one.